While reams have been written about burgeoning bad loans and the distressed debt pile of Indian banks, there may be a crisis looming on the horizon for another segment of India Inc. As the commodity slump gets stretched, so have the balance sheets of corporates with heavy dependence on commodities. Will the ticking debt bomb explode, or is there some relief on the horizon for metals, for ore and oil-related businesses? I'm Vikram Oza. You're watching The Debt Bomb. Joining me this evening in this discussion is Ajay Srivastav, CEO at Dimensions Consulting, also Kalpana Jain, Senior Director at Deloitte India. Great to have you both with us. At this point in time, I just want to understand the severity of the debt situation from you, Kalpana. Looking at the kind of cash flows that you've seen for many companies within India Inc., how is it really looking? Because for the longest time, we've talked about how some of these companies, how the Indian economy has really gained from low commodity prices. But the fact remains that certain Indian companies have taken the brunt of it as well. Correct me if I'm wrong.
No, without doubt, the debt situation with some of the Indian companies, particularly in the steel sector and in the upstream segment of the oil and gas sector, have been under a huge amount of stress. They are, as you rightly pointed out, overburdened with debt, and there have been various discussions around their restructuring and what are the possibilities of reviving them. Since it's not expected that in the immediate term, at least, they are going to see very good times, though we have seen certain degree of recovery, for example, in the iron ore prices, but which then tended to drop down again. There was a huge 55% increase in Q1, and then they've kind of stepped back around 25-27% again. So we do find companies in the sector in grave difficulties without exception.
So, yes, absolutely. Ajay, come in on this, because the government clearly wants private companies to step in and put in that kind of investment. I just want to understand about how leveraged these companies are that we are looking at, because these are the companies the government would be really counting on. In your understanding, the companies that have taken a hit on the back of the low commodity prices, how leveraged are they?
See, if you look at the Indian economy, by and large, Indian corporate sector, there are very few companies who are actually in the resource sector. If you take account the Sterlite and Sesa Goa, apart from that, it's all the PSUs in the resource center. So to that extent, one has not seen a resource price fall leading to a major issue on debt, barring maybe a couple of companies. I think the problem has come from companies in the end-use sector, if you ask me, which are like the steels Madam was alluding to. Those are sectors where the problem is partly operational and partly is the balance sheet structuring. If you look at, we go company to company and see what's happened. The banks lent money to the parent company. The parent company used the borrowings to subscribe to equity subsidiary company. The subsidiary company then borrowed money from the banks to set up the project, which was also gold coated by a margin of 3. And therefore, what you have there today is an unsustainable model of financial engineering as well as the basic cost. So it doesn't matter even if the recovery takes place. The cost and the balance sheet structure has gone to that extent where there is no recovery possible. So it's wrong to allude that the commodity fall has been one of the major ingredients in the Indian bankruptcy or Indian stress banking environment. It's the financial structuring and the gold plating which I would say primarily responsible. Yes, some prices have fallen like steel, etc., but those could have been mitigated if the balance sheet structure was correct. So to extend to say that these companies should give a benefit of commodity prices and they will come up and they'll recover. No, they can't recover.
Yes.
They are sitting on a leverage of 7:1, 6:1 on equity.
Correct.
And they are sitting on a gold-plated plant which is 3 times the value of what it should be. How would it ever recover even if the prices come back? So the question is not about recovery of commodities. Question is how do you address the balance sheet?
How do you address the balance sheet remains a moot point over here, and that's exactly what I'm trying to get at. What can be the fallout of the fact that these balance sheets aren't in the situation that they need to be? The government, like I said, Ajay, they want these private companies to invest in capex to boost economic growth, but the fact is that some of these companies that could be investing seem rather leveraged. Let me show you and our viewers, and we've been showing some of that even as you were speaking, the gross debt to equity ratio in some of our top companies, whether it's a steel play or infrastructure or telecom. There is some serious leveraging happening over here, and what isn't helping most of these companies is one of the factors you'd have to concede, Ajay, is the recent slump in our commodity prices. In your reading, really, Now, at this point in time, how bad is this situation for companies that we should be counting on to spur growth with their capex?
I don't think it's that bad as it's made out to be, because I think the issue is, one is that we have to get in fresh equity. That's one. The second is the local demand is a bigger factor. If you find local demand coming back, the money will be found to invest. The serious issue is that are the Indian banks willing to take a haircut, willing to go for a change of management, and that will strive these new companies to start investing into new capacities. They are sitting on good quality assets. Partly they have been implemented, partly the plants are not even working at this point of time. So I think the solution lies in the fact that is there a will in the RBI with the government to look for change of management in some of the cases and then move forward for further investment. If you take example like, just to take an example like Bhushan Steel, there was a change of management, but the banks went and gave the money to the same guy who had a problem with another banking system, and there was a CBI, right? So that's not the solution. That's not what will make people invest money. A new promoter comes in with new capital, he will invest money and enhance the capacity. And that's the solution to an Indian corporate sector in steel, etc. is get new promoters, get PE funds, take a haircut, and you'll find the companies changing tack. Present promoters have no incentive at all to invest because they are happily surviving in their company, making money. So why should they risk more for putting investments today? They're happy with what they have.
Kalpana, do you agree with the points that Ajay is making over here? If you can help us understand the kind of scenario as you see it right now, the current state of their balance sheets, whether it's Vedanta and the Aditya Birla Group with their players in zinc, copper, aluminium, Adani's port play in coal and coking coal. What's the impact on these companies as you see it right now when it comes to looking closer at their balance sheets?
So I agree partially and disagree with Ajay. On one thing, I think in terms of the government's expectation for the private sector to come in and put in further capital expenditure, I don't think there's a case for that, because right now we are sitting on huge surplus capacity in most of the sectors. And as Ajay rightly said, this is the user sector. So it's steel, for example, and I think we've been talking about steel as a case in point. So where is the case for making further investments when you have so much surplus capacity and there's no production up to scale at this point of time? What I do see, however, and what I do agree with Ajay on, is that there is a dire need for the balance sheets of such companies to be restructured. Not only for the balance sheets to be restructured, but also their portfolios need to be rationalized. So it's well and good to expect our banking system and the financial institutions to take a haircut. But I think there needs to be a far degree of accountability which comes in from the promoter groups as well, where they're willing to, let's say, participate in the pain, and they're willing to rationalize their portfolios, perhaps look at releasing finance for some of these distressed situations from part of their businesses which may be generating cash or which may not be so core to them. So some degree of consolidation in the sector is what would probably help far better than to just look at banks offering SOPs all over again. So there will have to be haircuts which will need to be taken all around for these companies to look reasonably healthy to take on any growth into the future.
Ajay, Kalpana speaking on steel. Tell me how you're seeing oil when you consider the slide in oil prices and measure its impact on Reliance and SR. What are the key takeaways for you? And I know that you're looking at this beyond the kind of commodity price play that we are referring to, but if you can put in perspective what you're seeing on the oil front.
So oil is in a sweet spot. If you look at the companies, barring SR Oil for all its group power, Reliance is doing very well, the OMC is doing very well. It's primarily government owned. There are maybe 2 companies in the private sector. So I don't think oil has made a major impact, because anyway in exploration, there's hardly any activity going on. We're not finding new fields. ONGC has been on its own steam, etc. I don't think too many private companies are bidding for exploration contract at this point of time. So I think exploratory side, for reasons of price, as well as the reason that there's no reasonable bigger enough gas finds or oil finds which are available. And I think the auction is about to happen. We'll see the lack of interest there because there's not much to be done there on exploration side. So not much impact on the oil side, I would say. In fact, oil has been a beneficiary because all the problems were coming from the marketing end of oil, which have been solved. So if you look at the oil pipeline chain, the new system of pricing to the market and passing on increases has given a lot of benefit to all the companies, including downstream companies. So I would say that fall in prices for oil has in fact been godsend for the Indian economy, of course it is, but also for the companies. Because the first time the whole pipeline, the whole chain, supply chain from production to supply is looking at a very great amount of positive on the balance sheet, profit or loss, low leverage. So I think that's the one sector which has gained tremendously, poised for growth, but growth where? They can only grow in distribution, they can't grow in exploration.
Correct. Correct. So that's the situation. And just to pull out the point that Kalpana was making on the steel sector as well, notwithstanding the government trying to help the steel sector with MIP, how is it really working out, you think, for Tata Steel and JSW, Ajay?
See, Tata Steel, nothing wrong in it. It's doing very well. It's got an Indian operation doing very well. They don't have such a big exposure to the mining part of it. So not a big deal about iron ore or any such thing. They have some mines. All right. So it's pretty good as far as I'm concerned in steel industry by and large with government putting import. They are doing pretty well, looking after themselves. But downstream industries are one which are protesting. So I think the turnaround of the steel industry has already happened to a large extent. The problem has come only from companies where the leverage is high for reasons other than business downturn. And I think those needs to be addressed differently. The business downturn related issues have been partly addressed, maybe not be fully addressed by the import duties. So if you look at all the steel companies, by and large, they're now recovering their operating costs and adding up to the gross profit margin has become positive. Now, yeah, if the prices go up dramatically, it may become better, but certainly not that they're not bleeding on the operating profit line anymore.
And what about the pain in infrastructure, Kalpana? How are you reading that? Because we've seen that slowdown and it's lasted way too long. JP, DLF, GMR, they've taken much of this brunt, as it were. How do you assess their propensity to push the cause of private investment right now?
In the real estate sector?
In infrastructure as a whole, yes.
Yeah, infrastructure as a whole in the real estate sector. I mean, some of the companies you mentioned were more real estate than otherwise. I think it's still going to take time for it to pick up the investment. The basic business case needs to be on the table. You have to be able to get the return that you're hoping to get within a reasonable time frame. And debt availability, finance availability to the sector is still a question mark. It's still not very much clear where the funding is going to be coming from. So most of my view on everything right now is somewhat up, somewhat down, if I may say so. I just want to make a point on the oil and gas sector you were talking about, and Ajay mentioned that, you know, some of the Indian companies have done fairly well. So I believe in the midstream sector, the refiners have been able to retain their margins, and again we have a huge installed capacity here in India, so there's been a benefit. The demand has been going up. The low price of gas has provided, in fact, a reprieve to be able to develop the CGD sector, for example, the city gas distribution sector. There is cheaper gas available to be distributed, and for this, for setting up the whole infrastructure for the same. So I think we will see it in bits and pieces where you will see positives and others which will still hold out and offer greed for a longer period of time. Perhaps.
So what you're suggesting is that we are somewhere in the middle right now. Ajay, if you'd like to come in on this, even if you look at a telecom sector, there'll be huge outlays required over there with the impending auctions. Would it be fair to say that capex isn't growing for the moment over there, and most of these companies, they aren't in a condition to raise their capex anytime soon? Because just going by the charts that we are showing our viewers, they're showing the impact of local commodity prices. The fact is that these companies have leveraged balance sheets. Their revenue realization is lower. They have weakened cash flows. Then how are they going to invest? That's the moot question.
See, bifurcate two things. One is infrastructure. I think the road minister has realized very clearly that infrastructure globally has always been a government-driven project. It has never been a success in anywhere in the world, including UK. We tried to privatize the rail system, hasn't done a great job at it. So I think the realization has dawned, at least in the road sector, that we need to have government to push infrastructure. Private sector does not work. And I think would go on to many other things. So unless, when you say crony capitalism, somebody gets a big money to set up a port, that's a different matter. But broadly speaking, infrastructure will be government driven. On telecom, I disagree. I think telecom, the people, companies have enough resources, we met all of them, to invest in any amount of infrastructure they want to do it. The balance sheets are not highly leveraged. If you look at Vodafone, is not public, so we don't know enough about the financials. But of course, the global balance sheet allows them to borrow cheap money abroad. Bharti is pretty well. If it divests Africa, for instance, its balance sheet becomes almost debt-free. So to that extent, whether it is Idea, Airtel or Arcom or Reliance Jio, I think all of them have a reasonably good balance sheets to address it, and the profitability is pretty strong. So I don't think Telecom suffers from lack of investment. I think Telecom has a different set of issues, which they have a very high payout to dividends at this point of time. They're looking at Bharti has got an Africa debt. That's the only problem. Reliance Jio, I don't think has a debt issue to borrow for infrastructure. Idea is a little more leverage, but still has enough money to put in. Vodafone doesn't have a balance sheet problem. So I don't think telecom industry is a balance sheet problem. I think the rest of the infrastructure, when you talk about roads and stations and airports, etc., yeah, there is a clear problem that the airport companies are leveraged at 6:1, 7:1, GMR and GVK. GVK did divest the Bangalore airport just now to raise some money to pay the debt. Not enough. But I think that would come from the government. I don't think private sector is going to do very much infrastructure in the next couple of years.
Well, the government is looking at the private sector right now to be able to spur growth levels to the extent that they'd want 8% and upwards. Whether or not that can really happen in this kind of current situation that we find balance sheets of some of our top Indian companies, that is the moot question. We'll get Soumyakanti Ghosh from SBI to shed some light on this subject. Of course, there are two sides to every story. We'll get the other side as well. How have commodity prices really played out? We're looking at the impact of that and looking at the holistic picture. Do join us. We'll be right back after this break. You're with us on Bloomberg TV India, watching the program The Debt Bomb, and we have been in conversation with Ajay Srivastav of Dimensions Consulting, Kalpana Jain of Deloitte India, and also joining us on the show right now is Soumyakanti Ghosh, Chief Economic Advisor at State Bank of India. Soumyakanti Ghosh, welcome to the show. There are two sides to every story, like I was saying before the break. These lower commodity prices, they've certainly helped some of our companies, and we can see evidence of that in the kind of earnings that have been reported for the quarter gone by. But then, is this earnings growth going to be durable? That's going to be an important question to answer. Can you help us dissect the growth in the Indian economy on the back of lower commodity prices from the kind of negative impact it has had on a significant set of Indian companies that are direct commodity players?
No, I tend to agree with the point which you mentioned. I think the decline in the commodity prices have actually helped the corporates in terms of the improvement in margins, operating margins. In fact, if you look into the last quarter result, there has been a significant improvement in operating margin. But there are 2 points over here. There is a clear distinction with the players who are more commodity dependent and who import a lot of them. So they have actually benefited a lot in terms of improvement of their margins. But if you actually look into the smaller players, you will find that the improvement they have not been able to benefit because of they have lower economies of scale, and also because of the fact that they don't import commodities to that significant extent. So there is a clear disparity which has emerged in this space in terms of the larger players and the smaller players. The other thing is that now that commodity prices have started to move up, even though I am not sure how long this will sustain, because the global growth is still remain weak. But if we assume hypothetically that is prices actually this trajectory may last for the next couple of months, then I think in that case also, given the current demand within the system, the volume growth is still a laggard because the demand has sufficiently not picked up. So if that is the case, over a point of time, if the volume growth doesn't pick up, the margins will actually get compressed.
Right.
So whichever way you look into it, I think it will entirely depend on how the system moves in terms of the demand pickup and hence the improvement in the margins.
But talking about the growth picture on the whole, Soumyakanti Ghosh, the impact of public or private investment should most definitely get reflected in jobs growth, in growth in our disposable incomes. How soon before that shows significant pickup? Because that's really where the action should be, right? When do we see real growth on the ground? That's the moot question again.
No, here also, if you ask me, yes, if I look into the growth prospects, if I look into our credit growth numbers, I still think that the credit growth numbers are at low double-digit levels. And apart from some sectors which are more consumption-oriented, I think investment is yet to pick up. And I still believe that the public investment will be the trigger to growth, because private investment, given the kind of leverage, given the kind of stress which they have experienced, will be hard to come by, at least over the next couple of months. So in my sense, and I think the government is doing the right thing in emphasizing on the railways this year, and that could be the possible triggers for growth for some of the sectors going forward.
Ajay, since the 2008 crisis, we've had at least two spurts in corporate earnings before it all died down and ran into lower lows. The first time was thanks to a fiscal stimulus by the then UPA government. We saw the maximum impact play out in the quarter that ended September 2009, and then we saw the second one in June 2013, thanks to that big depreciation of the Indian rupee, which really helped exporters. But now this last quarter has been the third such spurt we've seen. In the light of the commodity price rise and the other factors that you've mentioned, do you think this time it's going to be durable?
See, first of all, durability comes from a demand side, and I think that is where it is lacking, because the government as a model of fiscal prudence has decided to tax much more than all other governments and correct the government balance sheet rather than pump priming the economy. That's a strategy. It will play out in the longer run compared to putting money directly in the hands of the people. So very clearly you will see a stagnating or a kind of an agonizing slow rise in demand given the way the fiscal policy of the government is. Having said that, the point you raised first was the debt balance sheet. If you look at the top 200 companies in India, they are not over leveraged. They can invest any amount of money they want to if the demand side permits. So to take a corollary that commodity prices or the fall or the debt bomb has impeded private investment, I think is a fallacy, because the companies who whether it's Mahindra, the Tata, the Birlas, the Reliance, they don't have a balance sheet exposure of a kind which does not allow them to invest. They all can invest big sums of money, even the 200 companies, the MNC, the pharma, everybody. They don't sit on a debt bomb. Debt bomb is really focused around a very select bunch of old promoter-driven companies. So I don't think so today the debt bomb issue is hurting the private investment. What is hurting is the fiscal policy, which is, it's a strategy which says, I'm going to take the money, correct my balance sheet, and maybe spend the money down the line, so you will see a multiplier effect. Compared to a pump priming which says, I give the money to people, they spend it more wisely, they invest, they buy real estate, they buy whatever else, gadgets and goods and cars, and the economy comes up and tax collection comes up. Two different strategies. The strategy we are following tells us that the demand side will be agonizingly slow. Therefore, the capex will be slow, and it is certainly not because money is not available or there is a debt overhang on lots of Indian companies. That doesn't exist. So I think investment is all about demand. I don't think it's getting affected by ability to borrow today for most companies in India. Leave aside those 300 odd companies which have a debt issue.
Kalpana, how convinced are you about this argument? Because he's saying it's all about demand pickup at this stage. Because even if you look at a Reliance right now, it's invested 150,000 crores within 3 years. They don't have the appetite right now until they get the returns from their telecom investment. So my question at a larger level, is private sector investment likely to change at all? Especially if commodity prices continue to rise, or is that wishful thinking? Because here's the problem: if very high commodity demand from China is a thing of the past, then peak prices of commodities is also a thing of the past. So if the Chinese economy is pivoting, it's moving away from high manufacturing to high consumption, how will it structurally alter the commodity market, Kalpana?
So I did mention this earlier. I think I agree with Ajay that it is a question of demand. If there is a demand, there will be the investment to follow it. But before that, you need to utilize the capacities that you have installed available with you already to get a return on the investments that you have already made. And you rightly said that some of these large companies have made whatever commitments they have made. They will look for some degree of return on them, some surety in terms of the future of returns that they're going to expect before they make large commitments again. And the other point I wanted to make was that, yes, perhaps the top 200 companies have far healthier balance sheets, but the whole investment case from the private sector is really pushed by deepening it, by having many more companies involved. And I also agree that there have been companies which are in difficulties for reasons other than just commodity prices and demand too.
Right.
And they probably have not been as prudent as they needed to be, or they've been completely on the other end of the scale on this front. But then again, I think if you're looking at sustained investment, sustained development in infrastructure related sectors, if I can call it, then there has to be more than the few companies that have been investing over a period of time.
Right.
Those smaller companies need to have got their act together and have responded to opportunities which will continue to, maybe at this point of time, perhaps come a little more slowly than we would like them to come, or the government would like them to come.
Certainly, that certainly seems to be the case, because if this balance sheet repair is going to take a long time in the making, really, where does that leave economic growth? if it has to accelerate substantially to the levels the government is aiming for, the private sector will have to participate, and it has to go beyond the big companies that we have been talking about. Kalpana, Ajay, Soumyakanti, many thanks for joining us with your perspective. That's where we're leaving it. Thanks indeed for joining us this evening.